Ahora bien, los cambios en la gestión de los fondos individuales de alto valor o wealth management es otro tema de importante trascendencia para el mercado bursátil, dado que con el crecimiento de los niveles de ingreso en los mercados emergentes se espera que esta línea de negocio presente el mayor nivel de crecimiento en los siguientes años. Además, este tema es relevante porque debemos entender los retos que la industria está enfrentando en el periodo post-crisis y cómo las necesidades de este tipo de clientes han evolucionado durante los últimos años. Precisamente para hablarnos a profundidad de este aspecto, nos acompaña hoy el doctor Tom Robinson, Managing Director para América de CFA Institute de los Estados Unidos. Economista de la Universidad de Pensilvania y tiene un doctorado en Finanzas y Contabilidad de la Universidad de Case Western Reserve. Fue profesor asociado de la Universidad de Miami, donde dirigió varias maestrías y otros cursos relacionados con el sector financiero. Fue director y fundador de TR Robinson & Associates, firma de consultoría especializada en temas de inversión. Vamos a recibirlo con un fuerte aplauso. Bienvenido.
Good afternoon. I'd like to thank ASOBOLSA and BBC for the opportunity to participate today. Latin America is a very important market for us at CFA Institute. We have about 120,000 members around the world. We've been around for 50 years. Our growth here in the Americas as a whole, that I'm responsible for, U.S., Canada, Latin America, and the Caribbean, we're growing at about 4 or 5% a year in terms of members and candidates. Here in Latin America, we're growing well above that, actually 3 times that in Latin America as a whole, and in some countries we're growing as much as 30% a year. So it's a very significant market for us. Also, the private wealth area is very significant to us, and that's what I'm here to talk to you guys about today. We're known historically in the institutional space, in institutional fund management, but what we're seeing globally is an increasing number of our members that are practicing in the private wealth area. And that's particularly significant in the U.S. and Canada, and we think it's going to come to shape here in Latin America as well. So I'm going to talk about some of the same trends that Josh and Michael talked about, but I'm going to talk about them specifically with reference to the private wealth area and what they mean to us. I'm going to get into some sub-trends as well. So we'll talk about some trends in demographics, trends in technology, some trends in how the private wealth management marketplace is functioning, particularly the level of trust, which has been very low since the financial crisis started and is just now starting to come back and has a significant impact on how we serve individual investors. Then I'm going to talk about some of the new techniques in private wealth management practice that are coming into play today. And then lastly, we'll talk about some ways that if you are going to practice in the private wealth area, you can add value for your clients and your practice and set yourself apart, differentiate yourself from some of the other players in the industry. So first we're going to talk about demographics. And both Michael and Josh alluded to the aging population. Now you've had 3 of us talk about it. This is very important. It does create some risk, it does create some uncertainty, but it also creates a great deal of opportunity. So I'm showing the data in a slightly different form. So what this represents, 2013, is currently the percentage of our population that's in different age categories. So the percentage that are under age 14, age 15 to 24, 25 to 59, 60 to 79 in yellow is 80 and above. And that's where we are today, globally and in Latin America. And if you extrapolate that forward, looking at fertility rates and looking at mortality rates, we can pretty much tell what the population on average is going to look like in 2050, so a little more than 3 decades from now. And what you'll see is a significant shift, figure out where the pointer part here is, a significant shift in these upper 3 categories. So let's look at Latin America. So you'll see the green and the blue declining. Now that doesn't mean the number of people is declining. The number of people in all of these categories is actually increasing. It's the distribution. So out of 100%, how many are in each category? So if you look at the blue in the middle, from here to here, that's not increasing a lot as a percentage of the population. To put this in perspective, it's 30% more people. It's just roughly the same relative proportion in that particular age group. The significant changes are coming in the over 60 area and the over 80 area. So, for example, this purple here, that's about a little less than 10% of the population in Latin America are between age 60 and 79. By 2050, that's going to be 20%. Over 80 is about 1.5% right now. It's going to be almost 6% when we get out to 2050. So that's actually good news for the private wealth industry, because the clients that you want are the clients that are accumulating wealth, and then the clients who need to have that wealth managed while they're starting to distribute that wealth. So these three categories here are the bulk of where our clients are in the private wealth industry, and they're growing. They're growing in numbers, and they're also growing as a proportion. So the demographics in general are actually quite good for those of us that are practicing in the private wealth industry. Now, as Michael noted, it does come with some challenges. So what you have when you get up here is we see an increase, or we're going to see an increase over the next few decades in longevity risk. So the possibility that someone is going to run out of money over the course of their retirement. So that's a significant risk for your clients. It's also a significant risk for you, because if they run out of money, they may come knocking on your door and ask to move in with you. So we don't want that to happen. So it's going to require that we get up to speed on how we can help our clients accumulate more assets during the accumulation phase, and how we can help plan those systematic withdrawals so that they don't run out of money during their retirement phase. So there's significant opportunities here demographically. Let's look at the demographics of wealth. This is the amount of wealth that's held by high net worth investors. High net worth investors, as defined in this study, are those that have in excess of $1 million US of investable assets. Globally, there are now about 14 million of those individuals, and they hold almost $53 trillion of wealth. That number, both of those numbers, have increased 14% over the last year. Let's look at where that wealth is distributed globally. So Latin America is this $7.7 trillion. That represents almost 15% of the investable wealth of global high net worth investors that's here in Latin America. If we look at ultra high net worth investors, those are investors that have over 30 million US dollars in investable assets. A third of it globally is held here in Latin America. That's significant. So there's a significant amount of wealth here in Latin America that needs to be managed in the private wealth space. Now, the growth rates in Latin America, I should caution you, have been modest the last couple of years. So that investable wealth for high net worth individuals is growing at about 2 to 3% a year. It's growing much faster in Asia, but you still have a third of it here, so a very high base. So now let's get to some sub-demographic trends. Women, it's an important demographic trend. We're seeing an increasing number of women that are basically managing the household finances. They're in the workplace, they're earning money, and we're seeing some investment advisors focusing their practice on serving them. Well, why is that? Currently, this is based on US data. I don't have data for Latin America on this one. Right now, women manage or hold about 51% of the wealth that's out there. It's projected that by 2020, they're going to hold 2/3 of the wealth, control 2/3 of the wealth. That's a significant number that you need to think about. So now, they have different needs than a male investor. They live longer, okay? They tend to care for children, which unfortunately sometimes these days return to the nest. They also tend to be the caregivers for aging parents. So they have a lot of special needs. You also have to spend more time focusing on their retirement because they live longer. They need to save more. They need to invest it appropriately in order to have as much money as they need during the retirement years. Another important trend are millennials. So I'm a baby boomer. When I was in private wealth practice before I joined Academe and CFA Institute, most of my clients were baby boomers. Millennials are the new group that's going to be coming along. So these are basically people that were born after 1980. So they're in their mid-30s now, but over time, these are going to become your clients. So what's different about millennials? They spend a lot of money on consumer discretionary goods. They're going to make up half of our workforce by the year 2020. But they're also cautious. They also don't trust the financial services industry as much as their predecessors, the baby boomers, do. They care about risk much more than other investors do, and we'll see some data on that in just a moment. They also hold a lot of cash. So how much cash is that? It's about 50%. So this is a typical asset allocation for a millennial investor who's typically managing their own money. They're holding roughly 52% in cash. If we compare that to everybody else, that's about more than twice as much. So other investors tend to be holding about 23% in cash. I view this as another opportunity. If they're holding this money in cash, are they going to accumulate a sufficient return over time in order to have a satisfactory retirement? No. They're going to maybe keep up with inflation. So there's an opportunity there to educate them on the importance of investing in a much more diversified portfolio such that over time they can achieve a greater standard of living when they get to retirement. I'm not going to spend much time on this, but the demographics are also facing advisors. So advisors are getting older. That means there's opportunity for young advisors in this business to take over practices. From the older advisor standpoint, it means they need to start thinking about a succession plan. How do they transfer that book of business on to the next generation? All right, let's talk about technology. And some of these technology trends are actually driven by the demographic trends, particularly the millennials coming into play. Among high net worth investors, they're increasingly wanting to connect with their advisors digitally. They want to communicate digitally. They want to download their asset balance digitally. They want to search on social media for who the best advisors are. They want to rate those advisors on social media. They expect the same quality experience that they get when they're engaged with the website of Apple through the Apple Store. How many of you have websites at your businesses that rival that of Apple? We certainly do not at CFA Institute, which our members remind me of constantly. But we're going to have to get better at it if we're going to serve these millennials as they move through the demographic cycle. Social media. Most consumers today, when they're looking for products and services, they go to social media. And we're starting to see that significantly, particularly in the US, in the case of financial services. Globally, about half of the populations that are already connected engage in social networking. In Latin America, depending on which country, it's between 90 and 97%. Globally, of the top 10 markets for social media, 5 of them are here in Latin America, including Colombia. So people here are very connected and want to engage with their financial firms on a digital basis. All right, now this one is not an opportunity. For most of us, this is a threat. And this is something that it's just coming into play in the US, and it's moving very rapidly. And it's a very disruptive, it may be good for the clients, but it is disruptive to those practicing in the private wealth industry. And they're going to have to think about how they're going to distinguish themselves. And those are robo-advisors. So you go to a website, you enter in some basic information about yourself, it puts it through an algorithm, it does an asset allocation, and it then invests in a portfolio of typically ETFs. And they're doing this at very low fees. They're doing it at between 15 to 35 basis points, whereas the typical fee for private wealth is typically 100 basis points, 1% of assets under management. These robo-advisors, because they don't have as much human interaction and everything is automated, they're able to do it at a much lower cost to the client. That's, in some respects, that's good for the client, but is the client really getting everything that they really need to have out of that relationship? This is just 1 month. This is from April to May. So this is the growth in robo-advising, been growing at 30 to 4% just in a monthly basis in the US recently. These are the three largest, or three of the well-known ones: Wealthfront, Betterment, Future Advisors. These are all organizations that didn't exist very long ago. They're brand new organizations out there working in the robo-advisor space. So, how are you going to defend yourself against the robo-advisors? What does that mean to a private wealth management practice? Increased fee pressure. And we're seeing that across the industry. And Michael alluded to it in the institutional space. It's happening in the private wealth space as well. More transparency. You're going to have to explain to your clients what it is you're providing them for the fees that you're charging. Now, there's no, while typically in private wealth, it's a percentage of assets under management, there's lots of different fee structures, and no one is perfect. There's pros and cons to all of them. But for all of the different fee structures that are out there, including commissions, we're under increased pressure to lower that cost to the client. We need to accommodate the younger generation because those are the ones that are going to go for the robo-advisors. And if the millennials all decide to use robo-advisors, those practicing in private wealth are going to be out of luck in a decade or two. Requires more technology in order to interact with them, and it's going to result in increased cybersecurity risk, as Michael alluded to as well. So the more we use technology in our practices, the more risk we're going to get on the technology side. All right, the wealth management marketplace. Let's talk about what's happening there. So one of the things I mentioned or alluded to earlier is the level of trust in the industry. So this is a diagram of a typical financial ecosystem. You saw one before lunch as well. Basically, in this business, we're intermediaries. There are companies that need to borrow money or raise capital through equity in order to grow their businesses or start a new business. On the other hand, you need investors. You have investors who need to save for the future. Either they're saving for a kid's education, or they're saving retirement, or they're saving to buy a vacation home. And we basically serve this function as an intermediary. In order for a financial ecosystem to really be effective for all the parties, people have to have trust in that financial ecosystem. Well, what have we seen in the news year after year since the financial crisis? You know, we went through the initial crisis, which was largely driven by collateralized debt securities, as well as a bubble in real estate. And just when we get over that and we think it's safe to go back in the water, then you have LIBOR fixing. And just when you think that's over, then you find out that people have been fixing exchange rates in the foreign currency market. So this is what investors are reading about. Now, the people that are actually doing the bad things in this industry, there are a very small percentage of the people in the industry. But the Financial Times and the Wall Street Journal don't write front-page articles about the 99% of people in this business that are doing the right thing for their clients. They like to write about the scandalous stories, and it's justified. So what do you think that does to the level of trust that consumers, and in particular investors, have in the financial markets? So what percentage of consumers, not investors, but consumers as a whole, what percent of consumers do you think trust businesses in the financial services industry to do the right thing? And we'll do a poll. How many think it's over 75%? We had one vote. All right, how many think it's over 50%? Okay, we've got about 6 votes. How many think it's over 25%? And how many think it's below 25%? Okay, so those were about tied. And you guys pretty much got it right. So this is a study that Edelman, which is a public relations firm, does every year. And they rate all of the different industries that consumers do business with. So pharmaceuticals, automotive, technology, food and beverage. Financial services, since the financial crisis, has been ranked dead last. At less than 50% of consumers trust them to do the right thing. Now, if we look at high net worth investors, the number's a little higher. High net worth investors have about a 70% level of trust in the financial services industry. When you talk to an individual client about how much they trust their personal financial advisor, the person that's dealing with their account, it's higher yet again. So in general, consumers and investors do not trust the financial services industry. They don't trust financial services companies, but they do trust the human that they're dealing with, the person on the other side of the transaction. And that's very important. We asked Edelman does that survey every year. They've done it for over a decade. We asked them to do a follow-up study to ask a subgroup of the people they polled about what do investors look for when they're hiring a financial advisor. And they had choices. For example, the ability to achieve high returns, compliance with industry's best practices, amount of fees. You know what the top thing they look for is? That the individual that they're dealing with is trusted to act in their best interest. That's more important than even the ability to earn high returns. They're looking for that trusted relationship, which is what you need in the private wealth space. What happens if they don't trust us? They're not going to save, they're not going to invest. What does that mean when it comes to retirement? First of all, they're going to have to retire later. They're probably going to have to retire with a lower standard of living. They're probably going to have less wealth to transfer to their descendants. So it's really important that all of us do our part to rebuild the trust in the system. CFA Institute's doing a lot of things. I'll show you just one that you guys can use if you like. This is something called the Statement of Investor Rights. It's what investors should expect from their financial advisors. So, for example, independent and objective advice, clear, accurate, and timely communications, fair treatment with respect to other clients. Most investors don't know what their advisor does for them in terms of their ethical standards. And they're certainly not going to read CFA Institute's Code of Ethics, which is 140 pages long. So we created this as a very simple tool to educate investors about what the financial advisors that they're dealing with do for them. This is available, by the way, on our website in Spanish and Portuguese. You guys are free to download this, put it on your website, reference it on your website. It's a useful tool to stress to clients what we're in the industry are trying to do for them. Okay, Michael mentioned this in the institutional space. We're definitely seeing it in the private wealth space, where typically 1% of assets under management has been quite common. That number is coming down. I've got friends in the business now that they start off at a rate of 0.6 or 0.8%. We're seeing continued fee compression. It's hard to justify 1% of assets under management when you have single-digit returns in the equity market, at least over the long-term expectations, and very low returns in the fixed income market. Back when equity returns were running 10% a year, you can charge 1% of assets under management. That's only 10% of the fees. But if you're investing in a fixed income portfolio with an expected return of 4% and you're charging 1%, you're taking 25% of the income in terms of fees. Clients aren't going to stand for that, and they shouldn't. So there is going to continue to be this fee compression in the private wealth area. Other trends. Michael showed you some data on this, a trend towards passive investing. You have ETFs of every flavor today, and mutual funds as well, investing in indexes or sub-indexes. It's much easier today to be a passive investor. So you're going to continue to see passive investing in the use of ETFs and mutual funds in index products continue to increase. And we'll see some reasons why it actually makes sense to do that. Active investing is not going to go away. You need active investors in order for passive investing to work. You need people that are engaged in price discovery to making sure that the prices are in line with the fundamentals. People keep telling me that active management is going away and it's going to make the CFA program irrelevant. I hope I am the last active investor, okay? I long for that day. ETFs, as already mentioned, they're increasing in usage. Correlations are much higher than they were before the financial crisis. So this shows you, this is correlations between stocks and real estate investment trust. So typically below 0.5, look what happened leading up to the financial crisis and going into the financial crisis. Over an 80% correlation. And we saw that between every asset class except U.S. Treasuries. They were the only things that had a negative correlation when the financial crisis hit. Correlations have come back down a little bit, but they haven't come down that much. Correlations are higher than they were a decade ago, and they're going to remain high. Why is that? Index investing. Think about it. You put money into an index fund, the fund buys all the stocks at the same time. That increases correlations across the board. So we're seeing increases in correlation within asset classes, between stocks, and between asset classes. And because of the rise of passive investing, that's going to continue. We're not going to see it go away. It means you need to have a more diversified portfolio. When I was in school, we learned that you had to have 30 stocks to have a diversified portfolio. Today, you need to have twice as many as that to have a diversified portfolio because of the correlations. All right. Let's see. Alternatives. I'm going to skip this one since Michael already alluded to it. It's much easier today, particularly in the U.S., to buy alternative investments if you're a retail client. Let's talk about where you can add value. So there's a famous study that was done, and I'll actually go ahead and show it, in the 1980s. Don't worry about all the statistics here. This is one of the most widely quoted articles ever written about investment management. And what it basically says is that the most important step in the investment management process is doing a strategic asset allocation for your client. It trumps everything else. Very recently, we published a paper in our journal, the Financial Analyst Journal at CFA Institute, that took a fresh look at that using current data of mutual funds and pretty much comes to the same conclusion. The most important thing that clients can do is be in the market. They need to save and invest. The second most important thing they need to do is have a long-term strategic asset allocation. If you stop there and just buy passive index products, you're getting most of the bang for the buck that you need. You don't have to go any further. If you do go further and you do active management or you do tactical asset allocation, you can add value. But you have to be very careful to watch what the cost is relative to the value that you're getting. Okay, some other ways to add value. Tax management. Taxes are a significant drag on a portfolio over time. So if you want to add value beyond your investing prowess and do something the robo-advisors are not doing, actively tax manage the portfolio. There's been some really neat work done by some colleagues of mine, Steve Horan is one of them, on tax-adjusted asset allocation. If you think about it, if you're investing in a taxable account, the government is sharing in some of your risk. All right? Does that make sense? So when you do your asset allocation, you have to adjust your risk statistics for that fact. And what it comes down to is you should make active decisions about which investments go in the taxable account and which go in tax-deferred retirement accounts. Because you want the government to share in the risk, and you also want to put those assets that are taxed very highly in the tax-deferred account. So that's what we call asset location. And that's where you can add a lot of value for your clients. Retirement planning. You need to deal with that longevity risk. You need to help clients understand what a good, sustainable withdrawal rate is. How much they can safely take out of their portfolio and not run out of money. And there's a lot of good research on that. Connect with me on LinkedIn, and I'm happy to point you where it is. The last thing I'm going to talk about, and then sum it up because we've got 7.5 minutes left, is something called a life balance sheet. And this is some research that's been done in the last decade and which some investment firms are starting to implement. Instead of just looking at the investable assets, you want to look at all of the individual's assets. You want to look at their house. You want to look at their business. You want to look at their work and what the present value of their future employment earnings is. You want to look at their future liability that they need to satisfy in order to retire. And if you look at it holistically, you can add value to the client over what the next advisor is doing who's just looking at the investment assets. Think about it. I was a professor for 15 years before I joined CFA Institute. I was at the University of Miami, and I had tenure. My income stream was like a bond. It was guaranteed. I had a job for life if I wanted it. On the other hand, take a CEO of a technology company. His employment is more like a stock. Well, you should factor that into the asset allocation. If my employment is like a stock, I need more bonds in the rest of my portfolio. If my portfolio is like a bond, My employment is like a bond. I need more stocks in the rest of the portfolio. So you can add value by going beyond just investment management. So I'm going to stop there and talk about adding value. So what do you need to do? If you want to go beyond what the robo-advisors are doing or what the investment advisor next door is doing, first of all, you need to have a trusted relationship with your client. If your clients trust you, you will have a sticky relationship with them. They won't leave you. They're willing to tolerate the fluctuations in the market and the fluctuations in returns or performance of your particular fund. Compete on value added, not on cost. You cannot compete with the robo-advisors on cost. You need to go beyond that. You need to add value. Focus on the asset allocation decision. Looking at the demographics, you may want to think about concentrating your practice in the retirement area, helping people save and accumulate wealth, and educating them on how best to distribute that wealth. Use all of the tools in the toolbox. Higher correlations mean you need to have more asset classes in your portfolios. It means you need to have more individual investments if you're not using index products. Use all the tools in the toolbox. Insurance is going to become increasingly an important component of an asset allocation. And insurance should be factored in to doing the overall asset allocation. So with that, I have 5 minutes for questions, I believe. Thank you. By the way, I am on LinkedIn. That's the best way to connect with me. Happy to share these slides with you and refer you to any of the research on any of those value-added activities. Thank you.